OK, well, let's go straight now to ING financial markets economist James Knightley. Good morning, James.
Morning.
What do you think of these figures? They're slightly higher than expected, yeah?
Yeah, they are. I mean, market's looking for 1.4, came in at 1.5. If anything, we were looking for a slightly higher number than that, up at 1.6%. But I think this is really just marking the first of what could be quite a consecutive period of very sharp increases in headline inflation over the next few months.
And where does that leave the Bank of England then?
Yeah, I think we are going to see them have to write a letter at some point in the early part of next year explaining why inflation has moved above 3%, deviating by more than a percentage point from its 2% target. And I think that can be put down to oil, put down to lagged effects of sterling weakness, and also explained away by the VAT hike as well. So they've got plenty of ammunition to explain why it's happened and stuff that's actually partly out of their control. But again, they were likely to indicate that given the spare capacity in the economy, there's no real need to tighten monetary policy anytime soon, given that this spare capacity, given the weak wages and the weak labour market, inflation is likely to move quite sharply lower again through the back end of next year.
So what you're saying is that you kind of do see a peak 2–3%, and then it will just drop off again?
Yeah, I think that's right. I think particularly, with petrol prices, in sterling-denominated terms, the oil price is going to be about 90% higher in December of this year versus December 2008. So that's going to be a big boost, probably a full percentage point to headline inflation. You've got the VAT adding another similar amount as well. And those effects should gradually phase. So I don't think there's anything to be too concerned about at this stage.
You don't think Mervyn King's going to be under any kind of pressure to bring in some kind of policy changes then?
Well, I think, looking at CPI alone, probably not, but you've also got to consider what else is happening. And if we look at asset price inflation, then maybe there is something there. I mean, house prices now up around 8% from their bottoms. Equity markets continuing to do very well as well. And then also you have to look at inflation expectations in terms of gauging what the medium-term price risks may be. And certainly looking at the index-linked gilts, then there is some concern that those expectations are pushing higher. And also the Bank of England's own inflation expectations series, that's ticking a little bit higher as well. So certainly at this stage there's not too much to be concerned about, but potentially, if these asset price moves continue coming through and we do get the recovery story building, then there is going to be growing pressure through the middle part of the year to perhaps tighter monetary policy relatively quickly in the second half next year.
So you talk about tighter monetary policy. What could you actually imagine being done in the second half of next year then to try and control that inflation, if indeed it had to be controlled?
Well, I think also the Bank of England is going to be carefully watching for what happens on the fiscal policy side, because it is looking as though fiscal policy is going to be tightened pretty aggressively. And if we're going to be in a period where, the recovery is coming through, but it may be relatively muted given the headwinds faced in the household sector of rising unemployment, the debt levels, the higher taxes on top. I would suspect that we'll probably see them start to tighten in possibly August and then look to build on that tightening in the fourth quarter, with rates possibly ending the year about 2%.
James, thank you very much indeed for that.